The stock market is a wild place, and it has made a lot of people very wealthy. The main reason why people start investing is in order to get some returns for their cash in hopes for a better future. As Peter Lynch said, "I believe in stocks. If you look at the return of the last 72 years, stocks are the undisputed champs." And this quote, he's comparing it against other asset classes. And the fact is that when you invest in the stock market, there is a possibility that you can experience returns, as Palantir just did in the last year, where it rose over 140%. Of course, there is the other side of the coin, where if you would have invested in Lululemon around a year ago, you would now be down 20%. And you would have enjoyed a short period of being up over 15% of your position, but that would have been quickly erased when their earnings came out. However, again, another quote by Peter Lynch is that maybe you're right 5 or 6 times out of 10, but if your winners go up 4, 10, or 20-fold, it makes up for the ones where you lost 50, 75, or 100%. We all know that stocks are very volatile and that their prices can surge or decrease by a lot. This can impact your portfolio in many ways, but one of the biggest ways is that it can add concentration risk to your portfolio. Many investors believe that due to this, you should rebalance your portfolio every once in a while. However, today we'll be looking at if that is actually necessary and if rebalancing can actually improve your investing performance. In order to do this, we'll be using a concentrated portfolio example, where imagine you like to have a very few positions in order to track your investments, and you bought these 5 companies. You allocated 20% of your capital to Palantir, to Apple, Netflix, Salesforce, and Lululemon. All are large companies, all are growth companies, but all of them will perform in a very different ways in the upcoming period. Now, all these numbers are going to be invented, and you should only consider them for the example. This is a very solid portfolio because you're diversified. If Lululemon has terrible earnings, then maybe the earnings of the other 4 companies are enough to actually compensate for the price decrease that Lululemon stocks will suffer. But because the price of stocks moves in very different ways, some companies will increase at a faster pace than others, and the allocations in your portfolio will actually change. For example, after 1 month, your portfolio may actually look like this, where there were rumors that Lululemon was selling less, so its stock actually tanked, but there were rumors that Palantir was about to sign a very big client, so its stock actually increased by a lot. Of course, this is just 1 month, there are no big changes, but maybe after a year when stocks have had a lot more time to actually move around, your portfolio may then start to look like this. At this point, your portfolio could be up by 20%, where some stocks such as Palantir have risen over 140%, other stocks such as Lululemon have risen, but at such a slow pace that the percentage of your portfolio that is Lululemon is actually very low because all the other stocks have risen at a way faster pace. Well, now inherently, your portfolio is becoming very concentrated to 2 positions, Palantir and Netflix. But this is only 1 year. When you're investing in long term, 1 year is nothing. So let's look at the concentrated portfolio after 3 years. Over here you can see that now your once diversified portfolio now is extremely concentrated to 2 positions, where around 60% of your exposure depends on Netflix and Palantir. So the moment that one of these 2 stocks has negative earnings, this is going to heavily impact your portfolio. Now, there is a very widespread theory that in order to avoid this concentration risk and keep your portfolio diversified, you should rebalance every once in a while. What this basically entails is that you would be selling your winners, for example Palantir, which has risen over 140%, to get its allocation back to the 20% mark. However, during this period, Palantir actually reported a 27.2% year-over-year revenue growth, its fundamentals improved massively, and its debt position just got better. On the other hand, you would then have to buy your losers, so you would have to buy Lululemon, which is a stock that has reported only 7% year-over-year revenue growth in the same time period. What this would inherently do is rebalance your portfolio, so you would go back to your initial 20% for every single stock diversified portfolio. Of course, this will help you to reduce your risk and have a portfolio which has a lot more stability. However, I believe that this is wrong, and Warren Buffett agrees with me. He believes that selling your winners and holding your losers is like cutting your flowers to water your weeds. Because usually what happens is that when the price of a stock increases by so much, it usually is because their fundamentals have improved at a way faster pace than other companies, meaning that their revenues have increased, that their growth rates are even higher, or that they're more efficient at generating net income or free cash flows. So when you're rebalancing, you're actually punishing those stocks which are actually improving and becoming better companies over time. And you're buying those companies which are growing but at a slower pace. Now this can be proven when we look at the breakdown of annual stock market returns. This is by a very good book by John C. Bogle, which I recommend, but what the chart basically displays is the average annual return of the market, and it breaks it down into 3 explanatory variables. The first one is dividends. This is how much of the return is due to dividend increases or dividend payments. This, of course, is the most stable one because there's always going to be companies that pay dividends, and every time that they pay dividends, they're generating value because they're paying cash out to investors. Number 2 is earnings growth. Now, this is a bit volatile because earnings growth can sometimes be positive or earnings growth can be negative. For example, in the year 2020 or year 2019, due to the pandemic, the majority of the companies in the market had negative earnings growth. And the third change is the change in price to earnings. Price to earnings ratios for companies usually improve when the market believes that earnings growth are going to be quicker, or deteriorate whenever the market believes that earnings are going to grow at a slower pace. So for example, if we look at the breakdown in the 2010s, which is our closest or most recent period in history, 10.6% out of the 13.6% annual stock market return can be explained by the earnings growth of the different companies, meaning that changes in stock prices are mainly attributed to fundamental improvements. So if a company's stock valuation has increased by 10%, the most common reason is that their earnings have actually grown by a similar percentage. And this matches perfectly with what we were arguing in the previous slide. So does rebalancing actually improve your investment returns? Well, the quick answer is from 1987 to 2023, it doesn't. This is the total valuation and the results from investing in a 60% stock index fund and 40% bond index fund since 1987 if you reinvested your dividends. If you never rebalance your portfolio, your total value would be around $1.37 million. If you rebalanced annually, your total would drop significantly to $1.16 million. And if you rebalanced even more frequently at a monthly rate, well then your performance would be even lower, and your total will be $1.14 million. And yes, rebalancing improves the diversification of your portfolio, but no rebalancing rewards those companies and those asset classes which are growing at a faster rate, are displaying stronger fundamentals, and hence become greater and greater investments. As Warren Buffett again said, risk comes from not knowing what you're doing. Now, although rebalancing makes you be worse off, it does have some advantages. It reduces your concentration risk, it makes you more diversified, it leverages the mean reversion theory, which states that everything that has gone up very quickly or everything that has gone down very quickly will then face a reversion period, and at the end everything will have around average returns. Number 3, it allows you to realize gains. And this also provides you with lower volatility, as your portfolio will be more diversified and prices would fluctuate a lot less. However, I believe it has more disadvantages than advantages. The biggest one being the underperformance risk. Then you have market timing risk, where with your rebalancing you may be wanting to time the market. However, we know that this is not possible on a consistent basis. Now, number 3 is that you would have to exercise capital gains taxes every single time that you rebalance, where if you're a long-term investor and you never sell, you don't have to pay these until the very end. And finally, these would just increase your transaction expenses by a lot, which would end up eating into your long-term returns. So at the end of the day, my investing strategy is not changed. I do not believe in rebalancing the portfolio. Why diversification is only required when investors do not understand what they're doing. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.